We all talk about trades every day, but have you ever thought about what actually happens after a trade is executed? Let me break down the complete trade lifecycle in very simple words. Every trade starts with an idea. A fund manager or trader studies the market, forms a view, and decides whether to buy or sell. This decision is based on strategy, risk appetite, and market conditions. Once the decision is made, the trade is executed in the market. This can happen through an exchange, a broker, or over the counter. At this moment, the trade officially comes into existence. After execution, the trade is captured in the trading system. Details like price, quantity, and trade data recorded. This step is extremely important because any mistake here can flow through the entire life cycle. Next comes trade validation. Systems and teams check whether the trade details are correct. They verify product details, counterparty information, and legal setup. This ensures the trade is eligible to move forward. Now the trade is confirmed with the counterparty. Both sides compare trade details to make sure everything matches. If there is a mismatch, it is called a break and must be resolved quickly. Once confirmed, the trade is enriched with additional details. This includes settlement instructions, custodian details, and clearing information. You can think of this step as completing the trade puzzle. After enrichment, risk teams step in. They calculate exposure and margins to make sure the trade stays within risk limits. This is especially important for derivative trades. On a daily basis, the trade is valued using market prices. This process is called mark-to-market. Based on this valuation, profit or loss, also known as P&L, is calculated. Reconciliation ensures that our records match external parties. Positions and cash are compared with brokers, custodians, and counterparties. Any differences are investigated and resolved. Settlement is where the actual exchange happens. Cash and securities are transferred between parties on the settlement date. Once settlement is complete, the trade is financially fulfilled. Some trades continue beyond settlement. They may receive dividends, coupons, or undergo corporate actions. Options may be exercised, and derivatives may reach maturity. All trade activity is recorded in accounting books. This impacts fund NAV, financial statements, and client reports. Regulatory and investor reporting also happens at this stage. Finally, the trade is closed. It may mature, expire, or be manually closed by the trader. Once all cash flows are settled, the life cycle of the trade comes to an end. Throughout this journey, multiple teams work together. Front office executes the trade. Middle office manages risk and P&L. Back office handles settlement and accounting. Trade life cycle is truly a team effort. Understanding the trade life cycle is critical in finance. It helps reduce operational risk, ensures accurate reporting, and builds client trust. If the life cycle is strong, the entire operation runs smoothly. Thank you for watching. Don't forget to subscribe.